You're watching the largest capital misallocation in modern financial history unfold in real time, and almost nobody is naming it for what it is. Right now, while you're staring at red candles on XRP and HBAR, wondering if this thesis is broken, wondering if you missed something, wondering why every legacy financial outlet is screaming about Nvidia and the S&P 500 hitting its 11th consecutive all-time high, there is a silent dislocation happening underneath the surface of this market that the talking heads on CNBC are either too distracted to see or too compromised to tell you about. Here is the part they will not say on television. The same institutions printing the green candles in equities are the exact same institutions quietly building the rails for the next phase of capital migration. And that migration does not end in tech stocks. It ends in the infrastructure layer of the new financial internet. It ends in XRP. It ends in HBAR. What I am about to walk you through is not a hopium video. This is a structural breakdown of why the repricing event is no longer a question of if. It is a question of who is still holding when the rotation flips. Let me pull back the curtain. Welcome back. On this channel, we do not chase candles, we do not sell you fantasies, and we do not pretend the market owes anyone a payout. We decode the plumbing. Today we are dissecting the single most misunderstood dynamic of this cycle, the Great Rotation, where it is in its life cycle, and why the math underneath XRP and HBAR makes the coming repricing a mechanical inevitability, not a hope. Before we go under the surface, this is analysis, not financial advice. Let's jump in. Let's start with the hard truth. Roughly 90% of retail investors right now are staring at the wrong screen. They are watching the S&P 500 print all-time highs and concluding that risk assets are healthy. They are wrong. What they are actually watching is a concentration event, capital being funneled into a shrinking number of mega-cap names because the rest of the system is being starved of liquidity on purpose. This is the part nobody is explaining to retail the way it should be explained. The equity market and the crypto market are not in the same phase of the liquidity cycle right now. They are deliberately out of sync. And the entity orchestrating that desync is not some shadowy cabal. It is the structure of post-2024 monetary policy itself. Here is the mechanism. When the Federal Reserve holds rates restrictive and the Treasury continues heavy issuance, the marginal dollar in the system gets vacuumed into the safest, most liquid, most index-eligible assets. That means the top 10 names in the S&P. That is why you are seeing a handful of stocks up 300, 400, 500% year over year, while the broader market, and especially crypto, bleeds. This is not a bull market in equities. It is a liquidity trap dressed up as one. Now here is where it gets interesting for anyone holding XRP or HBAR. The exact same institutions that are currently parked in those mega-cap equity positions, BlackRock, Fidelity, Franklin Templeton, the sovereign wealth desks, are not parked there because they believe Nvidia is going to 2x from here. They are parked there because it is the only liquid place to wait. They are waiting for the regulatory gates on tokenized assets to fully open. They are waiting for the macro pivot. They are waiting for the cross-border settlement layer to finalize. When those three conditions converge, and we are months away, not years, the capital does not slowly drift. It rotates, violently, mechanically, and it rotates into the assets that have been engineered to absorb institutional scale flow without breaking. That is a list of maybe 5 assets globally. XRP is on that list. HBAR is on that list. You see, retail investors look at a red candle and they sell. Institutions look at a red candle in an asset they have spent 4 years building infrastructure around, and they accumulate. That is the difference between watching a chart and reading a market. Now let's do the math that the retail crowd ignores. Because once you see the numbers, you cannot unsee them. The global cross-border payments market is roughly $150 trillion annually. The foreign exchange market moves $7.5 trillion every single day. The total derivatives market is estimated at $1.2 quadrillion in notional value. The tokenization wave that BlackRock's Larry Fink himself has publicly anchored to is targeting at least $4 trillion in on-chain real-world assets by the end of the decade. These are not my numbers. These are the numbers from the Bank for International Settlements, from the IMF, from BlackRock's own investor letters. Now apply the constraint. XRP has a fixed supply cap of 100 billion tokens. Roughly 55 to 57 billion are in circulation. A meaningful portion of that is locked in Ripple's escrow, with 1 billion released monthly, and the vast majority relocked. Strip out institutional cold storage, strip out long-term holders who have not moved a token in years, and the actual liquid float is dramatically smaller than the headline supply suggests. So here is the question. If XRP captures just 1/2% of the cross-border payments market, not 10%, not 5%, 1/2%, you are talking about $750 billion in annual settlement volume flowing through an asset with a liquid float measured in single-digit billions of tokens. Think about that math. Think about what that does to velocity. Think about what that does to the price required to settle that volume without slippage. Because that is the part nobody talks about. A bridge asset cannot do its job if the price is too low. If you are trying to move $100 million across borders and the asset is priced at $2, you need 50 million tokens to clear the trade. At $25, you need 4 million. At $100, you need 1 million. Higher price equals lower friction equals more institutional usage. This is not a prediction. It is a design requirement. The same logic applies to HBAR. Hedera's hash graph is not competing for retail speculation. It is competing for enterprise data throughput, tokenized asset issuance, and council-governed institutional settlement. Its council includes Google, IBM, Boeing, Deutsche Telekom, LG. These are not memecoin sponsors. These are firms that do not put their name on infrastructure. They do not intend to use at scale. If you have a problem with these numbers, you do not have a problem with me. You have a problem with the arithmetic of global finance. While retail is panic selling on Iran headlines and oil price spikes, the institutional signal has never been louder. You just have to know where to look. Ripple's acquisition spree over the last 18 months, Hidden Road, Standard Custody, Mataco before that, is not a marketing exercise. It is the deliberate construction of a fully vertical institutional stack. Prime brokerage, custody, settlement, on-ramp, off-ramp. Ask yourself a brutal question. Does a company spend over $1 billion assembling that stack if the asset at the center of it is going to languish at current prices? Absolutely not. They do not gamble. They position. On the Hedera side, the council expansion, the tokenization pilots with major asset managers, the ongoing work with central banks on CBDC infrastructure, these are not retail-facing announcements. They are quiet, deliberate, and they only make sense if the institutions involved expect HBAR to be the settlement layer for a meaningful slice of tokenized real-world assets. Look at the spot ETF landscape. The XRP spot ETF approvals that have rolled through over recent quarters have brought in consistent inflows, even during periods when Bitcoin ETFs have seen multi-week outflow streaks. That is a signal. When the dominant asset is bleeding institutional capital and the secondary asset is gaining it, you are watching rotation begin at the institutional layer before it shows up in retail price action. Larry Fink has gone on record stating that the next generation of markets will be tokenized. Jerome Powell has acknowledged stablecoins as a legitimate component of the monetary system. The IMF has openly discussed bridge assets in the context of cross-border settlement reform. The Bank of Japan, the Monetary Authority of Singapore, the Swiss National Bank, all running pilots on infrastructure that the public XRPL and Hedera networks are uniquely positioned to absorb. This is not retail FOMO. This is calculated positioning by custodians and market makers who know exactly what is coming and exactly when the regulatory switches flip. Retail behavior in this market: complaining, panic selling, staring at 4-hour charts, swearing off the asset every 6 weeks. Institutional behavior in this market: signing NDAs, building rails, securing custody licenses, accumulating into weakness. You decide which side of that ledger you want to be on when the rotation prints. So when does this rotation actually trigger? Let me give you the 3 conditions, and let me give you the realistic window. Condition 1. A meaningful pause or correction in the equity concentration trade. The S&P cannot print all-time highs on the back of 7 stocks indefinitely. Either breadth expands, which would itself signal a liquidity loosening that benefits crypto, or the top decompresses, which forces capital to seek new vehicles. Either path leads to the same outcome for the infrastructure layer of crypto. Condition 2. Macro liquidity tailwinds. We are now in a window where the Federal Reserve's policy stance is shifting from holding the line to managing the descent. Every cut, every balance sheet adjustment, every shift in the reverse repo facility is liquidity that has to find a home. Historically, that liquidity migrates outward on the risk curve in waves. First into equities, then into credit, then into the high beta growth segments, and finally into crypto. We are entering the late stages of that wave. Condition 3. Crypto-specific catalysts. The digital asset market clarity legislation, the continued rollout of spot ETFs across multiple jurisdictions, the Japan FSA's evolving stance on token classifications, and the ongoing tokenization pilots involving major asset managers. Each of these is a green light. When enough green lights are on simultaneously, the wait-and-see capital becomes all-in capital. The realistic window for these 3 conditions to converge is the back half of 2026 into 2027. Not because I have a crystal ball, but because that is when the regulatory architecture, the macro cycle, and the institutional infrastructure all complete simultaneously. When that convergence arrives, the risk premium currently suppressing XRP and HBAR vanishes overnight. And when a risk premium vanishes on an asset with constrained float, the price does not move linearly. It gaps. We are moving from an era of abundance to an era of scarcity, and most people will not realize it until the door has already closed behind them. Look at what is actually happening on-chain right now. Exchange reserves for XRP are trending toward multi-year lows. Tokens are flowing off exchanges and into institutional custody wallets. Wallets that, once a token enters them, do not come back to market for a 10% profit. They are gone. They are gone for years. They are gone until the institution holding them rebalances at a price target that would make current holders genuinely uncomfortable to read out loud. The same dynamic is unfolding on Hedera. Council-controlled holdings, enterprise treasury allocations, and long-term staking are pulling float out of circulation at a rate that the average retail buyer is not even modeling. Here is the part that should genuinely concern you if you are still on the sidelines. The repricing does not happen in slow motion. It happens in a series of violent revaluations as each institutional gate opens. The first gate is regulatory clarity. Gone. The risk premium evaporates. The second gate is ETF expansion. Gone. The supply on exchanges thins further. The third gate is corporate treasury adoption. Gone. The float is permanently locked. Each of those gates removes a meaningful percentage of liquid supply from the open market, and each removal forces the marginal buyer to pay a higher clearing price for the next available token. The institutions have spent 4 years methodically shaking out weak hands. The 10/10 liquidation event was not random. The grinding bear conditions are not random. The endless cycle of FUD headlines is not random. It is the deliberate construction of an exit liquidity event, except in this case, the exit liquidity is the confused retail seller funding the entry of the informed institutional buyer. When the final switch flips, you will not be buying XRP at $1.19. You will not be buying HBAR at current levels. You will be reading a headline about an ETF approval, opening your app, and watching the price already 3 rungs higher than your last good entry. That is how repricing events work. They do not wait for you to be ready. I know it is tough to watch the red candles. I know it is tough to watch your bag underperform while a colleague at work brags about Nvidia. I know the macro headlines, Iran, oil, geopolitical shocks, create real fear, and that fear is not irrational. But as an analyst, my job is to distinguish noise from signal. And the signal in this market is clear, but only for those who are actually looking. The red candles are the smokescreen for accumulation. The FUD is the psychological warfare designed to shake out the hands that cannot hold through ambiguity. The low price is the silence of a predator waiting to strike. The boredom you are feeling, that flatness, that fatigue, that quiet voice asking whether the thesis is broken, is the calm before a systemic reset that will not announce itself. Being early feels exactly like being wrong, right up until the moment reality catches up. While the masses are focused on the S&P 500 chart, smart money is positioning in the asset class that the S&P 500 cannot reach into. While retail is rotating into AI stocks at all-time highs, institutions are quietly accumulating the infrastructure tokens that those same AI companies will eventually need to settle tokenized compute, tokenized data, tokenized everything. The question is not whether the repricing happens. The math has already decided that. The question is who will still be holding when the new floor is established. Because once that floor is in, the people who panic sold below the 200-week moving average will not be the ones buying back in. They will be the ones writing comments on YouTube explaining why the rally is fake and a correction is imminent, while watching the asset compound away from them week after week until the entry they wanted is a memory. History does not reward comfort. It rewards those who pay attention when the room is quiet. Here is the entire thesis in one sentence. The equity market is currently absorbing the liquidity that will eventually rotate into the infrastructure layer of crypto, and the assets engineered to receive that flow, XRP and HBAR among them, are mechanically constrained to reprice when it arrives. One is a bubble, the other is a bridge. The S&P 500 hitting all-time highs on the back of 7 stocks is not strength. It is concentration risk dressed up as a bull market. The quiet, grinding accumulation phase in XRP and HBAR is not weakness. It is the foundation being poured for the next phase of global settlement infrastructure. The question is, are you watching the noise or are you watching the structure? If you made it to the end of this breakdown, drop the word rotation in the comments. I want to see who actually understands what is happening underneath this market, not the surface story, the structural one. If you value this kind of deep dive analysis, subscribe and stay positioned with the rest of the informed. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient, stay rational. And as we always do, we don't wait for the future. We plan for it.